Okay, can you just confirm that you can see my euro dollar weekly on the screen and that my mouse is moving on the screen? Okay, perfect. Okay, so let's start. So just by looking at the weekly chart, can you tell me what three things we see here? What clues that the chart give us? Without even drawing any lines, what does the weekly chart give us? You can just type it in the message box. So there are three important things that this chart is giving us. Yeah, it's giving us the direction of which way we would like to trade. Excellent, Tyron. And anything else? Without the support and resistance lines, what else does the chart give us? It gives us the direction. And also, it would give us, based on the standard settings here, with your 633 EMA and your 200 period moving average here, and your 36 moving average and your 12 moving average. Your 633 moving average, it gives us a potential entry for a trade and a potential target. So if we are in a trade, you might take some profit off the table when it hits this level. That and the 200 period moving average, it's another area where you could take profit off the table, or you could enter a potential entry from this level. But the other nice thing that the weekly chart gives us, just by glancing at it, is that when we see the moving averages are like on the left here, it's spread apart and it's fanned out, especially our 12 EMA and our 36 period moving average. If it's spread apart like this, then this is showing us a trending market. And then when it becomes interwound, then it shows us that it's in a range. So just by looking at this, we already have a powerful indication of in which market state we are in. Fanning out, we are in a trending market. And interwound means that we are probably heading in for a range. And then again here, trending as it's fanning out. And then here again, it's trending again. So the weekly chart with all these standard EMAs are giving us a direction. It's giving us a potential entries and targets, and it's showing us the market state just by glancing at the chart once. So this EMAs helps us determine the market state. When it's interwound, like on the left-hand side, then we are in a range, and if it's spread apart, we are trending. And the 633, that's going to show us the potential targets or an entry if prices gets to that level. And your 200 period moving average, if prices are trading underneath the area, underneath the 200 period, then we will definitely feel more comfortable by trading short. So waiting for short in for a shorting opportunity. It's not always the case, because if you're underneath the price here and you find yourself in a good position to go long based on previous levels of support here, and you're looking for a long entry, then this 200 period moving average could become a potential target. You see? So it's not that prices are underneath and we're always trading short. It's just we definitely feel more comfortable trading short in this area. So which means we'll be waiting for opportunities up here, and then we're going short all the time. The 36 period moving average. What does the 36 period moving average show us? Yeah, try and participate and answer some of these questions. Yeah, what do you think the 36 period moving average does for us on the weekly chart? Yeah, it shows us it shows us a trend. Our 36 period moving average is our trend following moving average. Yeah. So when we're looking at this as a downward move here, we can see prices are coming down and then up, and then it tests the 36 period. It goes down, it makes a lower low, it goes up, and it's testing the 36 period again. And then it makes another lower low, comes up, tests the 36 period again, and then another time down, making the lower lows. And then at the same time, the highs are becoming lower, but it's respecting the 36. So our 36 period moving average is a very strong trending moving average. Yeah, it follows the trend. So when you draw a trend line, then try and draw it as parallel as possible to the 36 period moving average. And then the 12 period moving average. This is the blue line here. When prices are very volatile and it's not able to get all the way up as a retracement to the 36, then we call this a volatile trend. I'm going to show you that on the chart quickly. So it's also a trend following EMA, your 12 period moving average. But in this case, the prices are, if it's making a trend coming down, and that's my 12 period, or that's my 36 period there. Prices are making lower lows, but it's unable to get to my 36 period moving average. It's only able to go all the way up to my 12. So it's traveling so fast down that it's only getting to the 12 EMA. That's the blue line there, which means that your trend is very volatile. So it's not only giving us the direction or that it's in a trend and a range and potential targets, but it's also telling us how strong the actual trend is. So the power of the weekly chart is really showing up for us here now. Yeah. So in this case, if prices only gets up to the 12 period moving average, it's a very volatile trend. It's moving down very fast as compared to when it goes up to the 36 period moving average. Do you understand that, guys? So it shows us the direction. It shows us potential entries and potential targets as well. And that's all just on the weekly chart by giving it a 2-second glance. It shows us our market states, whether it be a trending or a ranging market. And then once you identify a range, then the next best thing to do is to go over to your normal standard classic charts. And then we could enter with a beginner strategy method. And if you have identified that it's a trending market, then it's best to switch to your Heikin-Ashi and then look for a trending situation and look for manipulations at each of these arrows here if prices are trending. So which time frame do you think we need to go to next now? Which one will be combined with the weekly chart? But from the weekly chart, and we're doing a top-down analysis, which chart do you think we should get to look at now at the next one after the weekly? Because we do, yeah, that's perfect. All right, Dalvin, are you still there? Are you with us? Okay. So we'll have to do the daily chart next, yeah? Right. Okay, so before we do that, let me go back to the live chart here on the weekly, just to do a top-down analysis on this pair so that you can see how everything joins together. Okay. So when you see prices are trading at a certain level here, you immediately see where prices has come from before and find out whether we have an EMA or some further confluence that helps us draw our two lines, which is going to be the resistance and the support. So in this case, the resistance is clear that we could just drop it immediately onto the 200 period moving average. We can look to the right and we can see that we are at 109.47. And then because we are so close to a round number, we can just say it is 109.50. So we have a round number, we have a figure, we have our 200 period moving average in this area. And this is where prices has pivoted off before. And if we look to the left, we can see here is a touch further to the left. And then even further, we have touches in this area over here, over there. We can see some reaction there. We can see there is a reaction all over if you go to the left. So there's numerous touches in that area, which makes this line now a respected resistance level. And then we have our support. So our support comes in the form of where prices has pivoted off before. So if we look, this year is a nice area where prices has actually moved up. So we could drop our line there. And also we can look further to the left and then find exactly where we could put this based on confluence. And remember, with the Japanese yen, we like using like the 30 number here. So it's 105.30 or 105.50 or 105.70. But in this case, we also have a moving average right there. And this is our 633 period moving average. So our 633 period moving average is being respected in this area here. And then, which means we can either place our stop loss, our support level here, or we could go slightly higher and place it up here. So in this case, because there's more confluence for me here, I'll place it here instead of at the bottom. But if it breaks through the bottom area, then the next support level could be there. And the maximum amount of lines that I'm going to put on this chart is going to be 4 lines. I'm not going to put on anything more than that. If prices decides to break through this resistance level here, then that would be my next resistance level based on the pivot off this area. And then looking to the right, it's 112.00. So the only reason I'm using the 00s here is just so that we could get an area that has a lot of confluence. So 106.70 would be the case for this one. And in this case here, we would have on the figure 105.00. Do you understand why I'm using these figures now and why I'm actually placing the levels here? Dalvin, you had an issue with why we are using the 00s or why we're using 70. Do you understand that now, Dalvin? Okay, this is all it is. Let me just explain it one more time. This is I'm looking for a resistance area, right? With this line here, I would like to move this down to a resistance area which is close to the price. Prices are right here now, and I would like to use this line to show me where, if prices breaks through this resistance, where would I like to have my next resistance. So I can see this 2 points where prices struggled before. So that is why I'm putting it down there in between the body of the candle and the wick of the candle. And then I look to the right and see that I'm quite close to a round number. So I'm going to move it down in this case to exactly on the 112.00. We don't have to do that. It's just that it's a round number and we can see it's being respected numerous times in the past. If I delete this here. So if we look at that round number now, we have just placed the resistance. I can see that's the reason I've placed it. And then I look to the left and I see there's another reason that I've placed it there. And then I see prices breaking through and then retesting that same area. And then I see prices going up, retesting that same area. So the area is very important. It comes down here and it goes back up. Here it comes all the way down through the level and it comes and retests the area again. And here as well. So I have many reasons now why I've placed my resistance area right there. The first one is because I have a lot of touches to the left. I'm looking left. It's quite close to price. It's pivoted off the year before, right? So we have a pivot there. It's pivoted off before. Prices has come up to the level, unable to do anything. It comes back down. And again, so I'm getting levels there. It's becoming very important. And then to solidify this whole idea, we look for our EMAs. This is all that the EMAs are there for. It's to help us with confluence, help us draw the lines better. And then to even, to really give you confidence in the level, you look at these prices here. So we're looking at the 00. We're looking at, whenever the yen is involved, I like looking at the 30 instead of the 20. And then I will look at the 50. And again, because it's yen, I'll look for the 70. And then again, 00 all the time. And with all the other currency pairs, I would be looking at 20 there, 50 there, and 80 there. So it's only these four. And if you're struggling with these numbers, you could just look at the quarterly numbers. Just look at these numbers. 00, 25, 50, and 75. So it's only to help you place this in an objective number all the time. We're trying to place it at these numbers all the time. It's because we see reaction when we go back historically. We see the reaction happening at these levels. So it's not only the numbers on the left here, it's also all the confluence that we have, that it's been respected there all the time. This is how I'm going to do this level part over again. Yeah, I'm going to do the level part over again. It's very important. This one quickly for Quinn. Yeah. Okay, prices are trading there. I just place a line in the middle because that's where prices are trading. Objectively, you will place your line there. I will place it there, and everyone trading this strategy is going to place their line right where prices are. Then they're going to take that very line and move it slowly up toward where they feel prices has pivoted before and where there is some confluence in an area. Now, in this case, we have a 200 period moving average right there. And we're in the middle of this body. I'm going to zoom in on this one. We're in the middle of the body and the wick. This is my body ending there, and that is my wick right on top there. And right in the center of that is where I would like to place my price. Now, it's right there in the middle. And then I look here and I see, oh, wow, it's actually quite close to the 50. So I will take it up to the 50, which means that you will place it there. I will place it there. Everybody's going to place it, the resistance in that particular area. Why is it important that we all place our figures basically in the same area? It's because the more people that's looking at a particular area, the better the chances are that there's going to be a stop hunt right there. That's the only reason. Nobody sees these little levels here. Nobody cares about the EMA. We're using it so that it can help us. Why don't we place out our resistance level there? Because we want it close to price and we're looking for more confluence. So if I place my level here, I've got more confluence. And then I just dropped it without looking at anything else. So now I'm going to look to the right and I'm going to see, I could place it at the 50. Why not? It's a round number. Why not place it there? And why would I want to place, where is my, yeah. Why would I want to place? Okay, where prices are right now, it's 100 pips toward my area. Yeah. So then you want another level up here, right? 300 pips away. If you want that level 300 pips away, because we have another confluence, yes, then do that. That means you are waiting for this to break and you're looking for a setup here, and then you want to get towards that one. The only reason you would want another level. But I like 2 levels because it hasn't got here yet. I'm looking for an opportunity, my first opportunity. I'm not looking for my next 10,000 opportunities here. I'm looking for the next opportunity. So this is why I'm taking prices close, and I'm starting off close to price. So I'm dropping for my next level. I'm going to remove this now because we're not anywhere near 100 pips away from anything yet. Yeah, I can use this 100 pip playing field. I can use that before it gets to the next one. And the more lines on the chart, the more complicated the whole thing is. And the more complicated the chart looks, the more hesitant you are to take a trade when it presents itself. So this is why I keep the whole thing as simple as possible. So I've got a line for my next line on price, and I'm moving it slowly down, finding out where my next area could be. Now, the next thing that pops out is this EMA here. You see that? It's popping out. It's showing me that this could be an area of importance. So I'm going to look there. But unfortunately, there's another major area over here. So now I have to choose between the two. But prices are far away from it anyway. If it's going down, in this case, my support line is going to be a target anyway. So this could be my first target in between the body and the wick of the candle. In the middle, boom. I drop it down. Now I dropped it down without looking at anything else. But when I do look to the right, I see I am very close to a level. What I'm going to do is I'm going to take it down, up towards the 107. I had it initially dropped here, remember? But we are so close to a round number. Why not just drop it down at 107? That is the only reason I'm using the figures there. And we call all those numbers the figure, the 00, the 50, the 70, the 80, the 20, and the 30. Those are figures. What's your figure on the right? Right? So now what we have is a decent playing field here of 240 pips. Right? Now, I'm sure none of you trades 250 pips at the moment. Yeah, you're only beginning with this now. But why would you want to place another line up here and another line up there just to confuse your issue? It just it clutters the whole chart. Leave it as simple as you can. The reasons you put your lines here now is many reasons, so they are good lines. Yeah. So now that I have my 250 pip playing field, yeah, and which means you know that when you get to this level, you would probably like to sell. And when you get to this level, you'd probably want to buy, depending if you have a bias on a particular pair or not. But if you don't, if you're purely a technical trader, then once prices comes down to a specific level here, you would look to buy. And if it gets up here, you would look to sell. Because that's what support and resistance is. And if it gets up to this level and it actually breaks through, your idea failed, then you can drop that in there as a next level and say, that is my next target now if prices breaks through this level and closes and produces a setup for me here. then I will reach toward that top level there. But for now, those are enough. Those 2 lines are enough, because we don't only have those 2 lines now, we have all our EMAs as well as confluence. You have your 200 per playing field, and then you drop down to the daily chart now, right? Now, the good thing that if you go back to the weekly quickly, you can see here that your EMAs are parallel. Yeah, they are not fanning out anymore. They are giving you a clue. I showed you in the beginning that the weekly shows you when the EMAs are fanning out. It means that prices are probably trending. And when they are interwound, they are probably in a ranging market. They are parallel here. So they are not trending anymore. So the strategy that we're going to implement when it's not a trending market is going to be the ranging strategy. Now, watch what happens here. We're going to highlight this area because we have identified that it's ranging. Yeah, we've identified that it's ranging because the EMAs are not fanning out. It's done fanning out. It's parallel. It's not showing us any direction. It's flat out, which means when prices comes up there, we would like to short. And this is what happened here. Prices comes up there on a support, on a nice level, and it has the EMAs here. So we would like to short on that level. So the date at this particular time when prices are coming up there is round about the November 24th or so. Yeah, at the end of November. So we're going to our normal daily chart here because we've identified a range, and Heikinashi is a trend trading strategy. And we've identified a range, which means we're not going to use our Heikinashi here. We are going to use our normal charts here, our classic charts. Now we've identified that it's ranging on the weekly, and it's the end of November. This is the area we are looking to short. And then there's a level of importance there. That is an area. Prices comes through that level. You're looking to short. Now, why are you looking to short here even more now? It's because when you've noticed on the weekly, prices are coming into the 200 period moving average, and you've drawn this line on your Heikinashi charts. As soon as the line comes through here, as soon as you're getting some sort of confluence in this area, you're dropping down to the daily chart. And Heikinashi is a trend trading strategy. You don't use Heikinashi to get yourself into a range trade. Heikinashi you're using to help you get into a trend trade. But you've identified here that it's ranging because you are now parallel. Your EMAs are parallel. In the beginning, I asked you, what does the weekly chart give you? What clues does it give you? It gives you direction if there is one. If there's no direction, the Heikinashi tells you if they are intertwining, they are ranging. So you drop down, or you look at your range, you look at your classic chart, because the classic chart is meant for the ranging, right? So your first ever chance of getting into a trade here is when you've identified a range. We can see here also that our ATR is sloping downward. There's no more volume. It's very difficult to make higher highs here because our ATR is pointing downward. So we have many reasons to look for a range trading strategy entry here on the end of November, starting off with this candle, 27th of November. We're looking just to short in this area. We're looking for a setup here. But do you see how it started off from your top-down analysis? You've identified the potential. You've identified that potential here. Now, if you see such a coincidence with your, I mean, everything is lining up here. You have a prices coming up to your 200 period moving average, right into a level of resistance that you've drawn, and you see on the daily chart there's an excursion beyond the mean. That is a very, very good clue for you to try and get short in the market there. Okay? So your first ever time, your first ever opportunity of getting into these sorts of trades are on the ranging market. Let me just explain that. This is I'm going to jump the gun here and do something I'm supposed to do in the next lessons only. Yeah. But let me just do this. Is everybody with me so far? Let me know if it's going too fast or if you need a further explanation on any of these things. Yeah. Okay. So the basis, the plan that you have set out. Yeah. This is a battlefield. The charts are a battlefield. Still. Okay. Was is it? The operative word there is was, which means you're no longer confused. Right. So what we have here, guys, this is everything. This is our level of importance here. It's everything. Yeah. If you have confluence here, yeah. If you have a trend line, not a trend line, a resistance line drawn here based on the numbers that you're seeing here, is a 00, 30, 70, or whether you see there is a pivot in that area, or whether you see one of the EMAs here, this is the most important thing in the whole game. And then you get your support here. This is exactly the exact same thing. What we're looking for here is confluence. Is this a real level or not? Yeah. Is this level going to be respected or not? Yeah. And the better your chances of having this level respected is going to be the more confluence you have here, the better the chances of this level actually being respected again. You've looked to the left and it's been respected. You are hoping that history repeats itself whenever you get opportunities again. And history will respect itself more if you have confluence of the EMAs, confluence of levels to the left, confluence of 00s, all those sort of things. So this is very important. The higher you go on the time frame, the more important these levels become. On a 5-minute chart, this means nothing. It is BS. It is nothing. It is noise. It breaks through it all the time. It means nothing. It means more on a weekly chart. This is why we start our top-down analysis on the weekly chart. We're trying to find these levels of importance. when prices hits this level, we want to take action. We don't know if it's going to break through that level and go long. And it could, because we can't know the future. Nobody does. When they say they do, they are lying. It is bullshit. Nobody knows what's going to happen at this level. The only thing we have is the chance, the probability that it's going to go short. And if it doesn't go short, there's no reason to look at the level and say, oh, what did I do wrong? You did nothing wrong. If the level was meant to break at that particular time, then that's that. Done. Look for the next opportunity. Okay? The secret is looking for these levels and taking action when it gets there. If the last few times it broke through and you went short, and then you become scared in this level for the next few trades, then you're going to start losing because you're not taking it short anymore. You're getting confused. You think it's going to break through. When it gets to a level that you noted it has been respected in the past, then do what you know best, which is to go short in these levels, irrespective of how many times it broke through and you lost. You need to find out how many times it's working for you in this particular level. So that's about the levels, yeah, and it's very, very strong on the weekly. Now, our first trade on this strategy, we are amalgamating the strategies here. Heikinashi is a trend trading strategy. When we're looking at this, we're not looking at a Heikinashi sort of an entry. We are looking at our daily chart entries, our usual excursion beyond the mean sort of an entry when it gets to the level. But your top-down approach really helped you here because you found that you have your 200 period moving average right there. You have a level right there. You have all the more reason to go short there. And as soon as you identify that and your playing field and your potential targets, thanks to your weekly. Yeah, I don't know how to spell weekly. Thanks to your weekly, you've got your playing field and all that stuff identified. Yeah, then it dictates to you whether you should now go to your normal standard charts, looking for an excursion beyond the mean, giving you even more reasons to take the short here. So the weekly is there only to identify your playing field, identifies your potential direction, identifies your market state. That's what it does here on the weekly. It is so strong. If you use it, it's going to improve your trading very, very much just by using the weekly chart, because no one else is doing this. Everyone jumps to the 15-minute and takes entries right there without knowing where their potential next targets are. So this is a powerful tool that you must use, and keep it as simple as possible on that weekly chart, a few lines only. So once you've identified that, you jump to your daily chart and you look for your excursion beyond the mean there. So you've identified everything and you've seen there is confluence with your 200 period moving average. Remember, your 200 period moving average is there. Your levels are there. Everything is there. And you know your potential target, right? Now you jump to your daily. In that same area, you've noticed there's an excursion beyond the mean. And then you take that trade based on what you already know. So far, I've shown you one particular entry method to get yourself into a trade here. After this, you will know 6 entry methods to get you into a trade here. This course shows you 6 opportunities to get you in here. So if there's no RSI divergence, you still have another 5 opportunities to get yourself in here. But what you need to know is when you get here, that what you want to do. Otherwise, all those methods means nothing. When it gets here, you know you want to short. And now it's not only that you've looked at the daily here, you've also looked at the weekly here to give you even more confluence that you are definitely looking for a shorting opportunity there. So it's a short there. Yeah, it's a short. Now you find your opportunity and you go. So now you are in the shorting trade already. Yeah, maybe I should just again, I'm jumping the gun, but let us just go to the 15-minute and see if there was any entry at the beginning of or the end of November. So this was the area. Yeah, it was. Now this is an opportunity on the shorting. This is what I call the circle of liquidity, and this is what you're going to learn in the next lessons. Yeah, this is an entry called the circle of liquidity. Yeah, and this one worked out for about 100 and odd pips. I took the trade somewhere here, and the stop, as you can see, is less than, it's less than 30 pips, and it went probably further down here. Yeah, I took this trade earlier on in last week that it did work out, guys. But that's not the thing. The thing is, you look down for your opportunity to get into a trade. You find an opportunity based on what you saw on the daily chart, on the standard charts, and what you saw on the weekly on your Heikin-Ashi charts. Yeah. So you already short on the top. You've identified that. So now you're jumping down to the daily chart now. Yeah. You already short at the top there. Yeah. You found your opportunity and you are short on the top there. Yeah. You've got short there. So on the daily chart, you draw a trend line. You identify a trend. And the trend line breaks. This is the next step now for the trading. You've identified that you would like to trade in between here and here. You've taken your first trade somewhere in that area already, based on what you've identified. Now your idea is constantly to trade it short because this was your target in the first place. So at the moment, you're already up by about 80 pips. But how do you get back into, or not back in, how do you add some more to this position? So if your idea is still going short, if your plan, your trading plan, your trading idea is to go short, the way to get in here, back in here, is to identify a trend line. And next week, I'm going to show you a proper trend, yeah? How to identify a trend line, how to read the trends. And for that, we're going to use Elliott wave and Dow theory. The trend line breaks. It breaks right here. You drop down to your 4-hourly chart. This is your area that broke. You drop down to your 4-hourly and you notice the break. It breaks through the trend line. When it comes back up to retest the trend line or to retest the 12-period moving average or the 36-period moving average, that is when you're looking to re-enter or to add to your position right here again. So you've taken your first position up here based on what you've identified already on your weekly Heikin-Ashi charts, and you drop down to the daily. You've identified this and you've gone short and you've made 80 pips. Then you retake this 80 pips and you add another position here, and you go all the way until it hits your target down here, if that's what it's going to do. But if it fails that way, you've taken some profit in this area, this 80 pips. Some of this profits you've already banked. But you still long on this position. You still feel that it should reach your target that you've identified already. It's a trend line break, retest of the trend line, and you're looking for an opportunity there again. Yeah? So if we stick onto this chart and we just look at this just one more time, just to let it sink in. This prices are coming up. It hits your 200 period moving average. It's in a decent level based on your number that you have here. It's based on the fact that it's respected the level before, based on the fact that there's an EMA. Then you jump down to your normal standard chart. Then in that same area, you have an excursion beyond the mean as well to add some more confidence that your idea to go short is a good one. You trade it short, you place your position there based on the entry method. You're in the trade already. Your first time into the trade is already there, yeah? And your target was 200 pips, remember? From round about there, 250 pips, we measured it. We said that it's going to be around about here on our Aikanashi. We've identified that. So our trading plan includes the idea of going short at an excursion beyond the mean, and it has confluence with your Aikanashi idea. And then now you want to go down. And how does prices get down to this level? It's going to trend down to this level. And how do you want to identify a trend? You use your Aikanashi. That is what the Aikanashi charts are there for. It's for trend trading. But how do you get back into a trade now? You've taken your first opportunity. So you know you want to go short. That's your idea. It's the daily. You identify a trend line break. The trend that's going up in the opposite direction. You're waiting for that line to break. And as soon as it breaks, as soon as it breaks, you're dropping down to the 4 hourly. It breaks through. You're waiting for a retest. Now, I like waiting for the 36 period moving average. And then I look for an opportunity there. That's what I like doing. Now, this trend doesn't look good, the one that's been created here. It doesn't look like a good trend. But I will try to draw my trend line parallel to the 36, because the 36 period moving average is my trend following moving average. So if I start, this isn't a trend because it only has the 2 points there. Yeah. So this one, it's not the proper idea. But if it was, then I would wait for a lower low, because trends are making lower lows and the highs are also becoming lower, and then a retest back to the line. Then I'm looking for another opportunity to trade there. I take another opportunity. So this is my second trend trading opportunity. My first, based on my idea, was up here on the range trading opportunity, the range idea. And it trends all the way down, so which means I'm looking for another lower low and a retest up. And I am trading another shorting opportunity roundabout there after a manipulation. So I've got into the idea here based on a range trade excursion beyond the mean, based on my daily and my weekly analysis. And then if I can identify a trade on a trend, this is how I will do it. I'll trade here, all the way down until I get to my goal, which is here. Adding positions here, and going down short. Let me see if I can find an example quickly at the back here somewhere. Yeah. So say, for instance, we had a trend line, and this is a trend line that's breaking over here, right? So the trend line breaks here. So it breaks there. So the trend line breaks, it comes down, and it retests. So I'll be looking for a trade. So my first opportunity would be somewhere here at the 36 as it's coming down to the 36. Or an identified trend line. So that's my first opportunity there. And then aggressively, there would be another opportunity. Why aggressively? Because that's my 12. I prefer the 36. There is an opportunity. And then here it breaks through. So this one was a lost opportunity. But I got into a trade here already based on a range trading strategy. And then I added a position there, I added one there, and I added one there. So I 4 times it's made me money, and the last time it's lost me money. So 4 times out of 1 time out of 4 trades, it's losing money here. But if my biggest trade here, I've got in on the first position here, it's already made 200 and odd pips. And I lost the last position trying to trade it long here again. Yeah. So that is one area. I'm just going randomly through the chart here just to try and show you how this thing works. So here's a trend that's been broken. And what you are looking for is a trend. So this, you need to bear in mind that this was your first opportunity to trade. This was your first opportunity based on a range. Now you're looking for your next opportunity, and your next opportunity is going to be based on a break of a daily chart. It breaks through the daily. There it breaks through, and it comes down and it retests the 36. You enter, re-enter. This is the way I re-enter the charts. Aggressively, you can re-enter there. The best area to re-enter is going to be your 36 period moving average, or even better, 36 period moving average together with a trend line. Then it makes again a higher high, and then you're looking for a retrace. And if it retraces back to a trend line or back to the 36 or the 12, you're looking for another opportunity all the time in these areas. Now, let me go back to the drawing board quickly. Okay. So you've identified those areas. You are going to trade short here, and you've traded. Prices has come up to the level. All right. It's come up, and now you're looking for a short there. So your first opportunity to trade is there. Then your second is you've identified this on your daily chart. It's a break. You're looking for the break of the trend line. That's on my daily. You're looking to identify a proper trend. Next lesson is to for homework, you're going to show me trend line breaks on the daily and a retracement on the 4-hourly. And then the next lesson is where I show you how to identify a proper trend, because this forms a very important part of the strategy. To identify it has to be a proper trend that you are identifying. But the homework will just be a trend that you've identified and a break of that trend line, and then a retracement on H4. That is all I'm looking for. And then see if you could actually follow that trend somehow. It means you are looking for lower lows, up back to the trend line, lower lows, up back to the trend line, lower lows, up back to your target. So you're looking for an opportunity there, and there after the daily break. And then you've identified this playing field. Yeah, that's your massive playing field there, 300 pips or whatever. So you've identified that this is a level. There's a creation of a stop hunt there, and then you go in long. You already long, right? Your first position is in. How do you get back in? You've identified the trend line on your daily. You drop down to H4. It breaks. Your trend line breaks. Then on H4, you're looking for a retest, coming back down, either to the 36 moving average or to the 12 moving average, or even better, to an identified trend there. A trend that's been identified. So now here you're looking for your next opportunity after you've taken that opportunity. You take your trade here, goes up. Wait for a retracement. Comes in, take a trade back in that area. So every time you're looking for a trade as it retouches the 36, the 12, or a identified trend line. Remember, the 36 period moving average is your trend following moving average. Try and draw your trend lines as parallel as possible to the 36 period moving average. When it's a 12 period, it means that the trend is very volatile. Yeah, there is your 12 period moving average is close to price. This is where it is. And then your 36 is back here. Now prices goes up and it's unable to, the sellers in this case are not strong enough even to push it down. This is my 12 and that's my 36. The sellers are not able to push down strong enough to the 36. That is what we call a volatile trend. The buyers are very much in control here because the sellers are unable to push down to the 36. So this is a higher risk, the 12. This is why I prefer using the 36 period moving average. Let me just draw that one more time, more clearly. So you've identified on your daily chart firstly, on your top-down approach, you've identified your playing field and you've identified this area you want to go short. So prices has come up because how did it get there in the first place? It's come up from there. Yeah, it's gone up to this level and now you're looking for an opportunity to go short, and that's your first opportunity. One, your stop loss is up there, you are in your trade. Your idea is to get all the way back down to here. How do you get to the here? You're going to assume that prices trends down to here. It doesn't range down to there, because if it ranges, it's in a straight line, it's never going to get down there. So we assume that it trades down to that area. That's the assumption that we are going to make. Our first trade is in the market based on our normal strategy, based on our excursion beyond the mean. And we've got confluence thanks to our Icanashi charting, top-down analysis, we are smiling at this point because we have a whole lot of confluence that we want to go short. We've waited for a while now for prices to get here. We traded and we are up by 80 pips already. How do I get back in? You identify a trend line on your daily chart that is broken. So where does it break? It breaks. Yeah. Maybe the trend doesn't look like that. Maybe the trend comes from this area here and it only breaks somewhere here. Yeah. But wherever the trend line breaks on the daily, a break and a close. Yeah. You're dropping down to your H4 level, H4 chart, and then you've identified that break there, and now you're looking for a retracement back up. And that retracement, if you have confluence of the 36, it retraces back to the 36, is very good. If you have a 36 plus a trend line, then that's even better, which means the trend coming back down here, you're getting a 36 period, boom, you want to enter your trade there. Or you want to look for your manipulation there. Yeah. So it manipulates, and then that's your second chance that you got in. Your whole idea is based on that you would like to get to trade right up to this area. So you have your first opportunity traded here, your second one here. Now, if this starts happening, we don't do anything because we haven't got our lower low. You need that lower low and a retracement back up and another chance there. All the time until it fails and it goes against you, or you got to your goal. But by this time, you've already traded over here. Your best chances of winning on this strategy is this first break. So prices are coming down to a level here. So you've identified that is a trend, right? You've taken your first opportunity and you're in the market. Now you look and you got your break. Your first pullback on your H4, and you see there's a trend line there. Your first opportunity, another stop hunt, you are in. That's my second opportunity. That was my first. This is my second, but that break and pullback is my first one based on the trending strategy. So, and then if it goes high and it pulls back, then this here is my second trade based on the trend trading. So as it's getting closer and closer to the target up here, it's looking bad on the chart now. As prices are, you've got into your first trade there, and then it's pulled back, and you got into your second trade there. As it's going closer and closer to here, the worse the chances are. This is your first opportunity. That was great. And this was your first opportunity based on the break of the trend line and the retest. That's going to be your best opportunity after the break. That's my best opportunity. That's my second best, third best, and it gets worse as it goes there. This is always going to be my best one after, obviously, the first opportunity with the range trading. Right. Do we have any questions on how this thing works, how the plan works? These first initial lessons are helping you find the zones of where to look for a trade. That's my first zone to look. That's my second zone. That's my third, fourth, fifth, and so on. So the first one is a range trading sort of a area that you are looking to trade in. And then afterwards, you're looking to trend toward the next zone. I'm going to put the microphones on now so that you can ask any questions. Okay, Tyron, do you have any questions on this?
No, it seemed all good. I understood it all.
Okay, perfect. All right, Dalvin, are you still there? Okay. Do you feel comfortable? Do you understand that we are looking for zones here? Yeah, that's all we're looking for. The next lessons are going to show you how to get into it when we get the zone. The zone is the most important thing. In the beginner strategy, Quinn, I'm giving you the microphone. If you can, I'm not sure if you can. The next strategy shows us the different methods to get into the trade once we've identified the zone. Okay. So, Quinn, just give me a thumbs up or a thumbs down that you don't understand it or whatever. Okay, perfect. Okay, perfect. So, which is our trend following EMA quickly? If you want to identify a dynamic trend, then which one of those EMAs are going to give us the trend?
The 36.
Perfect, that's right. Yeah, that's perfect. I just wanted to see if you guys are still awake. Okay. Now for the homework, do a top-down analysis on the majors, on any of the pairs. Do a top-down analysis on any of the pairs, right? And then identify the trend line breaking on the daily and you dropping down to the 4-hourly, showing me the retracement, that it's come back up. So you have your trend line that breaks. Firstly, you identify a trend on the daily and it breaks there. So that is the first part of the homework. The second part is you jump down to the 4-hourly and you look for that on the H4. And then that's all. This is where we will look for our entry. We've already taken our first one there. Yeah. So I want you to identify the first break pullback on the 4-hourly on as many charts as you can. And the pullback can happen based on it's coming back to a trend. It's coming back to the 36 or to the 12. The 12 is the most high risk. The 36 is better, but 36 plus an existing trend line is the best. This is the existing trend line coming down here. You have a touch there and a touch there, and you've got one. Yeah. And if you want, you can identify another, the second break pullback as well. Yeah. So it's a break of a trend line on the daily, and then you're dropping down to the 4-hourly, watching it break and retracing back to get in at a better price after you've already got in here. So is the homework clear?
Yes, clear.
Okay, perfect. Okay then, guys, that is it. The next lesson is going to be on how to identify a proper trend based on Elliott wave and Dow theory, and then the following lessons after that is going to be the 6 different entry methods to get yourself in. And moment, this beginning lessons are trying to find and identify the best possible zone to get in. Once you've identified the zone, then we are looking for the trigger.
So Rustin, sorry, is that using the normal charts or the Heikin-Ashi chart to identify the daily and then the break?
What would be nice is if you could, like the example that we had here with our yen. Let me just show you. If you can find a confluence like this, it would be great. This is why just give me 3 of the best that you can find. That is really what I'm after. Let me just show you. Like here, in this case, you've identified this on the weekly here, right? But at the same time, it's exactly the same situation here. Yeah. So a lot of the times you're going to see that there is some confluence on this. So what you can do is do a top down on the weekly, like trying to identify how big this distance should be here, what the distance is between there and there. That's the playing field.
Okay.
And then afterwards, then you can look at your how that actually plays out on the standard classic candlestick charts.
Okay.
And then all I want is that you guys already know how to get into the beginner strategy here with an excursion. So I don't want to see that. All I want to see is that there is a break on that daily. We've identified some sort of a trend. And if the trend breaks the 36 as well, you understand what I'm saying?
Yeah.
If it breaks through that, then it's even better. Because here you can see it breaks through it, it comes back up, and then it respects the 36 in this case. But now look at what happens in this case. You've identified a trend there. It's broken. And it's retested only the 12. Now, for me, this is a higher risk, but it's still a valid trade. Yeah. But I would probably want to place my stop loss way below the 36 in this case, which means my risk to reward is becoming worse now. This is why I don't like the 12 much.
Okay.
Yeah. Like in this case here, we have a break. Yeah. It breaks through the trend and it has a massive retracement. It breaks through the 12 and the 36, but it comes back up to a valid trend line. So I have 3 visuals to find a area to look at. But I'm always looking after the break. I'm looking, where am I going to get my continuation of that trend if it's going to continue? Yeah. So what we're identifying on the daily is a break of the trend, and then we're jumping to the 4-hourly. Retracing to either one of those 3 things, 12, 36, or a trend line. If you get a trend line with a confluence of the 36, that's the best. Okay, so whenever you guys are done with the homework, we can have again a 1-to-1 call on it, and then any things that you don't understand here, we'll clarify. Here, another one, if you find a break and then it pulls back here to the 36, that's where you're looking for a trade. But in this case, you didn't get a lower low, so you don't really like that one. Yeah, but do you see the pattern here? Do you see what it's doing? It's when it breaks, it seems the retest just works out, and it's always this first one that works out well. There it breaks, retest, look for an opportunity. If I look for an opportunity here now, I highlight that area. That's the 26th of November. If I can find the 26th of November there. Remember, I'm looking to go long there, and then yeah. This is the area I'm looking to go long in. Yeah, in this area. You can see there is some sort of a stop hunt in this area here. I don't see a setup here though, so I'm gonna take this. But I mean, the area, the zone is what we are looking for now. Yeah. Okay, so if there are no further questions, I'm going to leave you to do the homework. Whenever you're ready, just send me a message, and then we can discuss the times. Yeah, when you'll do it.
All right. Thank you very much.
Okay, Tyron, no problem.
Thanks. Have a nice day.
Cheers.
Yeah.
Thank you.
Okay, cheers, man. Bye-bye. Bye, guys.